Good morning, good afternoon, or good evening, depending on where you are in the world, and welcome to today's webcast, Keeping Agents Focused on Customer Acquisition, brought to you by Insurance and Technology, MajescoMastek, and broadcast by United Business Media, LLC. I'm Anthony O'Donnell, today's moderator. We want to make sure this event is as interactive as possible, so I'd like to make a few announcements before we begin. Excuse me. There are elements of this webcast that will appear as pop-ups, and we want to make sure you can view them. So at this time, we recommend you disable any pop-up blockers if you haven't done so already. This webcast event contains audience polling. The polling question will appear in the slide presentation window. Please complete the poll when it appears and click on the Submit Answer button located on the polling slide window. We thank you in advance for your participation. We encourage everyone to participate in our interactive Q&A session at the end of today's event. Please feel free to submit questions to our guest presenters at any time during the webcast. Just type your question into the Ask a Question text area below the media player window and then click the Submit button. The slides will advance automatically throughout the event, and if you'd like, you may download a copy of the slides by clicking on the Download Slide button located below the presentation window. If you experience any technical problems, please click on the Help link below the media player, and it will take you to our webcast help guide. You can also contact our live technical support helpline, whose number is located within the guide. And now on to the presentation, Keeping Agents Focused on Customer Acquisition. Discussing today's topic will be Karlyn Carnahan. Karlyn is a principal in Novarica's insurance practice with special expertise in e-business, marketing, and IT planning. Karlyn's recent experience includes serving as Vice President of Marketing for Fireman Fund's Commercial Lines Division, where she launched several successful programs, expanded online customer self-service capabilities, and substantially influenced IT strategy. She has also been Global Industry Manager for Sun Microsystems and served as Senior Vice President of Product Development for InsWeb. Our second speaker today will be Richard Hayburn, Controller Insurance Accounting at AAA Mid-Atlantic Insurance Company. Rich has 20 years of experience in the auto insurance industry, most of which has been with AAA Mid-Atlantic, where he has held various financial and project management positions. Rich has held his current position since 2008. And finally today we'll hear from Erik Stockwell, Senior Vice President and General Manager, North American Life and Annuity Division at MajescoMastek. Erik has 15 years of industry experience working for large insurance carriers, including the Hartford, Nationwide, and Transamerica. He has held line of business management positions in these firms, including running sales, finance, and product development teams. He has a history of achievement, innovation, and building growth organizations. Now I'd like to make a few comments on today's topic. A competitive advantage never stays one for very long. Competition causes the bar to rise, never to fall, and so it has been with insurers' efforts to provide their distributors with ease of doing business, and so also with the vogue for multi-channel distribution strategies. As insurance carriers operate in the most challenging economic environment in years, if not decades, customer acquisition and retention is more important than ever. That means managing every traditional aspect of distribution interaction better while increasing the breadth and complexity of one's distribution. Carriers have made significant progress in speed to market by implementing rules-based systems and tightening their product development capabilities. They have aggressively moved to create more tailored products, marketable through more diverse channels. However, their engagement with those channels remains challenged by the limitations of their existing distribution systems. Those systems are, in many cases, antiquated and isolated within separate business units. They are ill-adapted to the demands of modern multi-channel strategies, making it difficult for carriers to rapidly integrate new channels, to onboard new agents and competitively manage compensation, and to track the licenses and qualifications of those agents for compliance purposes. Carriers that wish to remain competitive need to be able to juggle the complexities of distribution channels and the individual distributors within them. They need to manage their distributor and regulatory transactions in a more timely fashion, and they need to monitor the performance of their distribution strategy through ongoing profitability analysis. In today's discussion, we'll take a closer look at those challenges, and we'll talk about some of the strategies and solutions that insurers can bring to bear. And with that, I'd like to turn the floor over to Karlyn.
Hi, this is Karlyn Carnahan, and you can move on to the next slide. I work with a firm called Novarica, and Novarica, we act as retained advisors to ensure senior executives in operations and in IT. We publish research on a variety of topics, business trends, technology trends, best practices in insurance, all relating to the intersection of insurance business practices and technology. We also publish research on peer group behaviors, and, of course, we do vendor analyses. We also manage something quite interesting. It's the Novarica Insurance Technology Research Council. This is a group of over 200 CIOs and senior executives in the insurance industry. And they participate in a lot of the research that we do. So you'll see some of their input through the presentation I'm about to deliver. We are a division of Novantas, the leading financial services management firm out of New York. Next slide. Anthony mentioned that the insurance industry is in probably the most challenging economic environment that we've seen in decades. And looking at the numbers, it becomes quite clear that that's absolutely the case. Premiums have been down 3 years in a row. The market is actually shrinking. And this is the first time on the property casualty side that we've seen this kind of a decline since the 30s. A number of things driving it. Rate decreases. For workers' compensation, we've seen payroll declines as unemployment continues to rise or hold at a very high rate. Property values are down. As the economic times begin to impact our policyholders, they tend to reduce the kinds of coverage that they're purchasing. So we're seeing a tremendous drop in the revenue side of the business. And by the way, the costs have been rising as well. The cost of medical continues to rise, the loss costs continue to rise, and our is down. And what this means is that profitability is severely stressed right now. Next slide. Now, that holds true on the property casualty side, but we're seeing the same thing on the life insurance side as well. Huge drops in the new business premium growth. If you look there, 2008 down 7%. 2009, final numbers aren't in, but it's looking like it's been down 15%. And that hope for 2010 may be wishful thinking. Maybe not. Maybe this is going to be the year that we completely turn around and we see an enormous growth over last year. Next slide. Similar type of trends in the variable annuity world. Again, continued decline year after year in the new business being sold there. So we're sitting here in a time that is quite challenging for insurance carriers. And in a highly competitive market, what carriers need to do is to try and extend their channels, appoint new agents, optimize their current distribution model in order to drive more revenue. Next slide. So in the competitive times, insurance companies really require focusing much more aggressively on their overall channel strategies. A number of issues and questions that carriers have to examine. First of all, which production channels should we use? Or which ones should we add? Maybe we currently use independent agents. Should we be considering going to the web? What about bank channels? Are we using personal producing GAs, PPGAs? So there's a number of different types of channels out there. And so the first question that we have to be looking at as a carrier is where do we use these different channels appropriately to target our customer base? Where do we add them? And can we reduce the cost of adding new channels or managing our existing channels? Looking at which agents to grow with. A typical insurance company, obviously has growth plans. And if you say, gosh, I'm going to grow 20%, well, that's got to come from your distribution channels. Which particular channels, which individual agents are we going to grow with, and how are we going to do that? Of course, are we incenting our sales force to do the things that support our strategic direction? Are we paying them properly? A lot of carriers have difficulty putting flexible compensation programs in that stimulate the strategic direction simply because their systems don't offer them the kinds of flexibility that they need to have very focused incentive programs. And of course, for a carrier, you've got to be looking at, are we investing our time and our energy in those producers who are most likely to do a good job for us, to grow with us? And that may be your large producers who are already producing a big book of business and you expect will continue to grow. But it might also be for your new distribution channels and for your new producers, making sure that they are onboarded appropriately, making sure that they've been trained on your products, and providing them with that face-to-face attention early on in the relationship so that they build a loyalty to your company and can have the kind of growth that you need. Now, in order to support robust channel strategies like this, there's a number of things that a carrier really requires. You've got to have very flexible compensation models. You need to be able to compensate both on a transaction basis, but to put in incentive compensation plans that reward the channel for those aspects that you're trying to drive. In competitive times, that may be growth. It may also be retention. Some folks include a loss ratio component or a profitability component in their incentive plans. Some organizations have not only incentive compensation programs that are payable over the course of a year, but may have contests that occur during the course of the year, kind of short bursts, and those need to be tracked and modeled as well. So flexibility in handling compensation programs becomes a very critical capability in order to drive a robust channel growth. And obviously, in order to create appropriate compensation models, you've got to have good analytical tools. You have to be able to understand which characteristics of your distribution channel actually drive profitability and drive growth. Business process workflow, being able to rapidly move tasks from one party to another, first of all, assure consistency in the process, but also can squeeze efficiencies out of the process. And again, when you start looking at what's happening with the overall financial results of the insurance industry, operating more efficiently is a very important characteristic. The industry right now is operating at, I think it's a 101 on the property casualty side. And, at 10, 20 years ago, that was a great number. That was a very profitable number. But today, in order to get the same kinds of returns that you got on a 101, you really need to be driving to a 95. And so, again, finding ways of eking efficiencies out of the system become quite important. Rapid onboarding of new channels. If you're going to start expanding your channels, you need to be able to bring new agents on, bring new channels on very quickly. You don't have the luxury of waiting 30 days or 60 days to handle and process all of the paperwork and to make sure that the licenses are in place. And agency self-service is a very, very critical capability, and I'll talk a little bit more about that. But let's move on to the next slide. When we start looking at the different channels, the independent agency channel is still the most widely used. Over 50% of all insurance premiums are now being written through independent agents. Now, on the personal side, that continues to decline. We're down to about 30% being written by independent agents, and the rest being written as I think the III would call this all direct, which would include employee agents at those firms that typically use employed or the direct agency force. In the commercial insurance world, independent agents continue to play an enormous role, and in fact, most of the direct writing here is for the BOP or the small business. And in life, we do see a huge component that really is driven by captive agents. So it's easy to say, well, the independent agent is really who we have to focus on, but carriers have a wide choice of channels today. Independent agents, captive agents, the web, their own call centers. On the life side, there's broker-dealers, bank channels. When you're looking at using a multiplicity of channels, managing compliance, compensation, and relationships across these different channels can be quite challenging. So whether it's assuring that they're in compliance with the right licenses and appointments, or managing multiple compensation programs pitched at these different channels, technology really acts as an enabler. Next slide. When you start to look, though, at the independent agency channel, the question becomes, how do you become the agent's top choice? What makes, go back to that slide that you were showing. That's the one. What makes the carrier an agent's top choice? Now, this is based on a survey that I did of independent insurance agents across the nation just about a year ago, and we asked them to consider their top 3 carriers in terms of where they place their production. So the number 1 carrier is the carrier across all of these agents that they place the most business with. The number 2 carrier is where they place the next most, and the number 3 carrier is where they place the third most. I want to point a couple of things out here. First of all, as you see, the number 1 carrier outperforms the number 2 carrier in every single dimension. And the number 2 carrier outperforms the number 3 carrier in every single dimension, which tells us that differentiation is possible. The most highly ranked feature is convenience. How easy are you to work with? And I want to come back to that because this really hits on the whole self-service aspect. But look at where we've got a very, very tight banding here in commissions. What this tells us here is that this is an area where we can really differentiate. There's still room here for differentiation. Top carriers are already differentiating. They're already saying we're very convenient to work with, we're responsive, we're fast to work with, and all of this is enabled by technology. And lastly, where we see a huge gap is in this underwriter relationship, but frankly, the underwriter relationship is no longer about chemistry. It really tends to be more around these technology-enabled capabilities, such as response, underwriting speed, and convenience. So moving on to the next slide, how do we handle this differentiation in commission? It's not necessarily who pays most. It often is around how we process the payment. And this is typically done in a distribution management system. So I want to talk about the typical solutions out there and the key components that you find. So distribution management solutions are used to manage the various aspects of channel relationships. You typically will find 3 primary functions: compliance, compensation, and some kind of a contact management or a customer relationship management. Compliance includes all of the functionality required to onboard an agent, as well as to assure that their licenses and appointments are maintained. Now, historically, this has been a very manual process. Field reps would gather the information from the agents, would create contracts, which are stored in the field offices. Appointments were done manually for every state, every company, and every line. They would be done across the book of business because they took a long time, so you couldn't do them as needed. You did them in advance. Checking for out-of-state licenses, validating license renewals was spotty because of the complex paperwork and because of the expense. So all of this manual effort led to errors, delays, the possibility of market conduct fines, and frankly, it took a long time. It took a long time to onboard a new agent. So distribution management solutions available today automate this whole process, making it very simple to onboard new agents and adding consistency to the practice of ensuring that your agents are properly licensed and appointed before the business is issued. As a note, agent self-service is a key feature here in the compliance area in terms of the onboarding, as they are able to manage their own demographic data and update their own credentials if necessary. And typically what you'll find is that the compliance portion of the system does exactly that. It manages the producer demographic data. Who are you? What is your address? Who are the people that work there? It'll track credentials, your continuing education, your licenses. It will administer distribution hierarchies, and this is a very critical capability because you have so many layers of hierarchy. So imagine, if you think about it, you may have you may want to look at the results for a book of business. That's 1 level, written by a producer, 2 levels, who works at a territorial office, 3 levels, of an agency, 4 levels. It's a division of a national broker. That's 5 levels of hierarchy right there. So having support for multiple hierarchies makes it easy to analyze the results at any one of those levels without having to do a lot of manipulation. Compensation, commission management can be a challenge for many carriers with millions of transactions, thousands of producers, multiple compensation plans that may vary by line of business or by type of transaction or by location. Each channel has compensation complexities, and incentive programs and sales contests only add to that complexity. So the commission management module typically allows for a very easy creation of compensation programs, both transactional compensation as well as complex incentive or bonus payments. They typically also include the ability to automate payments and real-time tracking. Of course, the whole forecasting and modeling is also an important capability. Contact management or customer relationship management in the distribution space is more than just maintaining the names and phone numbers of the key individuals. Managing call reports, managing annual goals, managing their business plans allow really a field rep to manage a day-to-day relationship with a producer. So in addition to capturing the critical partner information, this ability to analyze data and to manage the overall relationship with the various distributors is pretty key to driving revenue. So tools that facilitate reporting, modeling, and analysis help marketing officers analyze the effectiveness of compensation plans and make some strategic decisions on how to enhance revenue. Common across these different modules typically are some level of a self-service component, so a producer can go in and pull their own commission statements or can update their own licenses, some level of analytics so that you can do some robust modeling, document management, and, of course, workflow capabilities. Next slide. So what is the current state of distribution technology in most carriers? Well, frankly, distribution systems are aging. This isn't the type of solution where there's this enormous business case that is really readily apparent, initially. People look at this and say, well, we can live a little bit longer with our distribution system. And often it is a convoluted patchwork of multiple applications, a lot of manual processes, and so you get a lot of fragmented information, a lot of manual support. Typically, there are separate systems for each distribution channel, so trying to get a consistent picture of how a channel is performing across different products, across different divisions can be a challenge. And the compensation is usually decoupled from the compliance, definitely decoupled from the relationship management. So you've got information in a variety of systems, difficult to pull it together. And frankly, the older distribution systems were really rooted in the financials, not in actual channel management. And certainly there was a huge lack of self-service ability. Next slide. So what we see is that there are a number of drivers that are causing carriers now to begin looking at replacing their systems, and they are getting some returns out of this. First of all, one of the key drivers is it's become quite difficult to add new distribution sources in a timely manner, possibly because there's a limitation on the hierarchy supported, or in some of the older solutions, there are limitations on the number of producer codes. So when we're sitting here in a time where the industry itself is shrinking and we're faced with, tremendous pressure for growth, if we can't add a distribution source, we're certainly not going to generate production from them. Difficulty adding new compensation programs. So you've come up with this great new way of really stimulating and driving growth, and you can't get it into the system, you can't get it implemented. Sometimes it's a limitation on the type of program, sometimes it's a limitation on the types of the products that are being supported by these compensation programs. A lot of manual, inefficient processes often lead to errors in calculations, late payments, underpayments, overpayments. This inaccurate data or late data also means that there's often some reduced services provided to the producers. Right, we can't get you your commission statement on time. We issued your incentive check, which was completely manually calculated, and gosh, it's wrong. It doesn't make for a solid relationship with your distribution channel. This also, these older systems leave you at risk for market conduct problems. It's difficult to track the licenses, make certain that when you've issued a policy that the agent is licensed appropriately, tracking the continuing education requirements, and of course anti-money laundering rules are now in place that we need to be considering. And finally, one of the key drivers for replacing distribution technology, frankly, is the lack of data. We can't pull data out of our current systems, so it becomes very difficult to understand the effectiveness of any of our compensation programs, and it becomes difficult to plan on how to channel growth. In fact, other surveys that we've done with Research Council show that predictive analytics and business intelligence, one of the areas that carriers are getting the most bang for their buck out of it is in terms of managing the distribution channel, because they are finding ways of pulling information and doing that analytics. But if the information isn't readily available or is in multiple systems, in a variety of formats, it becomes quite difficult to even get to that level of capability. So I think we're going to move to a quick poll now, if you want to move on forward. And Anthony, do you want to manage this?
Yes, thank you, Karlyn. You will have seen the poll question that's come up, and I'll just read the options for you. We ask you to fill this out while we do this. Which of the following issues does your organization face? And the options are difficulty adding new distribution sources in a timely manner, difficulty adding new compensation programs or limitations on types of programs supported. Next option is errors in calculation, late payments, underpayments, overpayments, for example. Following option is difficulty tracking licenses and credentials. Next option, manual inefficient processes. And finally, lack of data. I think we might just have put all of the above. Before we push the results to this question as people answer it, I'd just like to reiterate that you can ask questions to our presenters at any time, so feel free to ask a question relevant to what Karlyn is talking about now, and then again with our following presenters. And we'll just take a couple of seconds and we'll push the results of that poll. Could we bring up those results, please? Okay, well, there we go. We see a fair distribution between options 1, 2, and 5. The biggest choice was difficulty adding new distribution sources in a timely manner, followed by a tie between difficulty adding new compensation programs, limitations on types supported, and also manual inefficient processes. With that, I'd like to hand it back to you, Karlyn.
Well, that's terrific. This is really interesting information, and I think what's surprising me the most is how few of you are having errors in calculations, because we definitely have seen this as an issue with a number of carriers, but terrific for you guys. Definitely this difficulty adding new distribution sources and difficulty adding new compensation programs, manual inefficient processes, these are very key across the industry, causing a lot of problems. If we want to move to the next slide, let's start talking, though, about what some of the benefits are when you begin to implement some of these more modern channel management tools. First of all, much faster, much easier onboarding of new agents. The processes tend to be fairly intuitive. It's a great way of capturing information. There tends to be workflow capabilities built in, and of course with agency self-service, they can go into their own portal, add their own information, and the workflow then pops tasks off to the appropriate people for approvals. The consistent tracking of licenses and education, particularly for the solutions that have been integrated with something like a National Insurance Producer Register. Decreased cycle time for compensation changes. You can very quickly make new changes, and of course increase accuracy in the calculations. Big benefit, the additional data and monitoring of the performance metrics, and that allows you to really enhance your ability to target, forecast, and create your channel strategies. Improved agent satisfaction through self-service, and what you saw through the survey was that that convenience and that ease of doing business is one of the biggest drivers of where an agent chooses to place their revenue. Reduced operational costs, eliminating the need to maintain multiple systems, which can be quite costly. Increased security and audit controls, and a huge financial benefit, frankly, is the reduced print cost by not having to produce commission statements anymore. Just a couple of notes there about some folks who, have had some tremendous capabilities or improvements. Blue Cross Blue Shield of Vermont, who happens to be the largest private health carrier in Vermont, saved over $500,000. Simply by decoupling their commissions from their premiums and reducing manual interventions. And, of course, by going paperless on the commission statements. And Penn Mutual reduced the amount of time that they needed to implement the new compensation plans by 75%, and the compensation accuracy dramatically improved. So definitely some hard figures here in terms of key benefits. So next slide. Bottom line, what I would say is that distribution systems have a tremendous amount to offer to a carrier, particularly if you're a carrier that has a complex distribution strategy. the consistency in ensuring that your licensing and your appointment process is in compliance can definitely help avoid market conduct fines. And just to note that, this is tough times for states as well, and market conduct fines are definitely a point of revenue. Something to continue to watch and manage. Processing the commissions and the incentive programs in an automated way certainly saves internal time. And compensation programs, for sure, incentive programs do provide a very easy way of motivating producers to place more business with a carrier. Lastly, providing access to these tools through self-service meets a frequent request by agency principals, and being able to model and utilize analytic tools makes it very easy for marketing execs to stay on top of how well a channel is performing and intervene earlier. So we recommend that insurers who are looking at these types of systems narrow your overall market choice by focusing on providers who have experienced staff who understand the industry and understand your needs, a stable organization, a solution with a level of functionality that you're requiring, and, of course, a technical architecture that's compatible with your enterprise standards. And with that, let's pass it on over.
Well, now we'll hear from Rich Hayburn at AAA Mid-Atlantic. Rich?
Okay, great. Thank you, Anthony. Thanks, Gil. Let me give a little bit of background. First of all, I'll give a little bit of background on who we are and to describe some of the challenges that we faced as we sort of switched out some of our policy administration systems and billing systems over the past couple of months, and what sort of challenges it led to with the distribution and compensation management solutions that we were looking for. And then basically take a look at how we look to solve these challenges. A little bit of background, if you look at the next slide. The AAA Mid-Atlantic Automobile Association is actually commonly, I'm sorry, one slide back, or the AAA as it's commonly referred to, is North America's largest motoring and leisure travel member organization. The AAA organization provides our members with broad ranges of travel, automotive, financial, and insurance services. Throughout the North American continent, nationally, AAA is basically a total network of about 50 or 60 locally and regionally independently owned and operated automobile clubs, and collectively have in excess of about 50 million members. AAA Mid-Atlantic is the fourth largest club in that consortium. We have approximately 4 million members in our operating territory. AAA Mid-Atlantic Agency, we own a full-service personal lines insurance agency, and basically the largest club subsidiary is actually a personal lines property and casualty insurance carrier, which is referred to as the AAA Mid-Atlantic Insurance Group. And it's really the sales distribution management needs of the insurance group that I wanted to focus on this presentation. Looking at the next slide, what sort of makes us unique or makes us different as far as what our sales distribution models are? Well, not unlike many other property casualty carriers, we sell insurance products through various channels. We have direct sales representatives, both that are commissioned and salaried, and we also have multiple independent agencies selling our products. But what sort of makes our model unique is the overlay or the introduction of marketing agreements that we have with the different AAA clubs throughout our territory. Now, some of these clubs actually own their own independent sales agencies, and when that occurs, we generally have a traditional independent agency and commission agreement directly with those agencies. However, we also have marketing agreements with the clubs themselves. And when we have these marketing agreements with the clubs themselves, we've actually introduced the concept of an affiliation fee as a way of means of compensating these clubs for products we sell to their membership base through our own direct sales force. Now, simply put, this affiliation fee concept, mechanically it operates very similar to a commission schedule that most people are familiar with, but it's driven by parameters that are really external to the normal agent and agency relationship. In my mind, a typical agent and agency relationship is usually a many-agent to a single agency relationship where they're generally operating under a single agency agreement and a single comp plan. Again, it can have multiple layers, but they generally operate under a single agency agreement. The affiliation fee model that we have is structured a little bit differently, where it actually comprises many agents to many agencies, or many clubs, in fact. Now, each of those different relationships could have transaction rules that differ given the governing administration of the compensation plan related to each individual club or each individual respective agency within those clubs. What that does is actually bring in a kind of a different complexity to the model. Now, because we have these complex relationships with so many different clubs and with different partnered agencies, agencies that are truly independent and agencies that are independent but working under the umbrella of another club, we really wind up with an ongoing appearance of channel conflict in most of our sales territories, and most of our sales transactions have that appearance of conflict. So as a result, we've become very saddled with a data-intensive and a rules-driven series of compensation plans that really left us with a need to find a configurable system whereby we could administer our club and our agency compensation programs. Basically, the next slide, I just wanted to give a quick picture of our agency hierarchy. Now, on the surface, it sort of might appear more simplistic than it really is. But what I just want to do is get a quick walkthrough to demonstrate some of the situations that we needed to address with the solution we were looking for. Obviously, the top box is the carrier level, is the insurance group's level. The second and third rows signify basically the equivalency of the agency entity levels. And the first box to the left there is the Mid-Atlantic Insurance Group agency, which basically that represents our direct sales channels. And again, as I mentioned earlier, in our direct sales channels, we have captive agents, we have salaried agents, commissioned agents, and we have house agents. So collectively working under the umbrella of the agency associated with just the insurance company, a wholly owned operation. The second box is where we sort of bring in a kind of a new element to the matrix. The AAA club represents the various club partnerships that we have. And again, we have those partnerships with clubs that have their own independent agencies, which generally drives a commission. And we also have those clubs where we have marketing agreements, which drive what I described to as affiliation fees earlier. And we have independent agencies, which is on the far right, and following the schematic all the way down to the far right, it's a traditional independent agency with multiple agents working for them. But to the immediate left of that, where we have a description of MAG employee hosted at AAA club agencies, again, I don't want to get that to be too confusing, but we have another unique arrangement whereby some of our independent agencies allow us to host our own agents within their territory, which creates another sample of complexity in a compensation exhibit. One of the examples that I wanted to relate to when I said that we have situations where we have a many-to-many relationship on agencies to a compensated entity is if you look at the red dotted line, we have an individual agent that actually works under the umbrella of the direct sales force for the Mid-Atlantic Insurance Group and actually sells products associated with the AAA Partnered Club number 2. That individual could actually write policies associated with the AAA Club Partner number 1, and number 3, and number 4, and number so on. So we have a whole distribution network on our direct sales side that actually results in compensation eligible to other clubs. Each of those could have a unique and differentiating compensation model and rules associated with them, which adds another level of complexity which we needed to solve for. The purpose of showing the slides, I really didn't want to bore you with our dissertation on our sales distribution models, but really to simply illustrate that we do have a series of distribution channel strategies that we needed a solid solution for. Looking at the next slide, just wanted to illustrate some of the reasons we were seeking a distribution management solution. We needed a way to manage our unique requirements that are related to our compensation and producer life cycles that are really driven as a consequence of our combined agency and club marketing agreements, and one which you can actually filter through the difference, the complexity of the channel conflict that was readily apparent in our marketing territories. Secondly, we needed to manage our producer information chain and control change over our producer life cycles, and we also needed to manage the related flows of sales, data, commissions, and reporting along the lines of what our intended channel hierarchies were to be. The next series of slides details some of our requirements and what the distribution management solution was going to be for our organization. First of all, we needed to have a tool which comprehensively managed our agent registration and our agent onboarding routines, inventorying the multiple agent types that we were going to be working with, and the potential relationships that each of those agents could have, in addition to their licensure tracking and setting their sales permissions. Secondly, we needed an application which was capable of managing sales entity relationships and their associated hierarchies, as well as defining producer roles, which in our situation could potentially change over the course of time. Third requirement we were looking for in a solution was what we needed a portfolio management tool to deal with transfers of books between agents, transfers of books between agencies, as well as properly administering termination, suspense, and restriction activities within the compensation calculations. And the next slide, we indicate that one of our requirements as we were looking for a solution was that we were looking for a rules-driven commission calculation engine, which was capable of administering our commissions, our affiliation fees, as I mentioned previously, and actually some other unique compensation types that we developed within our network, but also combinations of those for each policy sale that we would generate. And also, too, the last significant requirement that we were looking for in a model was having the needed flexibility on administering payment frequencies and really clearly defining the payment modes to entities. Our different partners obviously were entitled to different compensation levels depending on the specific agreements that we were operating on. And as such, we needed to make sure that we were able to report to them whether or not the compensation was commission eligible, affiliation fee eligible, or other, or a combination thereof. And looking at the next slide, talks a little bit about what we were able to find with the product from MajescoMastek. Basically, what we found was a solution capable of supporting and integrating with all of our distribution and compensation models. Secondly, the hierarchy management capabilities were user-defined and flexible, and that really addressed some of our need related to the change management of our distribution channels. And the routines clearly allowed continuity management over agent transfers, terminations, and other changes that were important to us to administer. The compensation manager component, in my view, was worthwhile in the fact that it was a rules engine-driven model, which really put our compensation routines in the hands of our business users and actually gave us some greater flexibility by not necessarily making it IT programming dependent to work with going forward. And then obviously down the road, we also see the ability to expand the scope of the product's features to include self-service functionality for our producers, which should go a long way in establishing additional confidence in our products and services that are entitled to our agencies. So I know I kind of went through this pretty quickly, and I hope I didn't use up more time than I was allotted, but I wanted to thank you for listening, and I'll stay online if there are any questions as the program continues. So I'd like to hand off to Anthony if I think there's another poll question.
No, we're going to omit the poll question in the interest of time, so okay. I'll turn the floor over to you, Erik.
Okay. Thank you, Anthony. Thank you, Rich, and thank you to everybody joining the call. And yes, to allow some time for questions towards the end, I'll move quickly through my section. But my name is Erik Stockwell, and I'm Senior Vice President with MajescoMastek, and spent much of my career working inside of large insurance companies, as Anthony mentioned, and dealing closely with distribution. And I have a first-hand understanding of the urgency of compensation data and the importance of accuracy to good producer relations and ongoing growth. Next slide. Think of the concerns of several of the distribution management stakeholders. The distribution head is interested in growing distribution, attracting profitable producers, and tying them closely to the company. So they need flexibility in setting new compensation contracts, they need speed in setting new hierarchies, and they need good, actionable management reporting information. The producer desperately needs accurate information and fast, high-quality service. Now, most of us have a set salary, and yet we still wait for our pay stub to see what's going in the bank. Imagine what a producer whose compensation is highly variable week to week and month to month, and just wonder why they are highly attuned to the commission calculations and contract credits and reconciliation capabilities. And the producer really wants answers to the how, where, and when questions of their payments. and they want self-service control over choices of how they get paid, where the payment goes, and when it gets there. So if the carrier can provide personalized payment options and reliable self-service, the producer will reward the carrier with more loyalty and ultimately more business. And the CIO is interested in a flexible, modern architected distribution management system that can be a core strategic platform to grow with the company. The CIO needs low cost of ownership, meaning that the more lines of business that can flow through the strategic distribution management system, the better. And the CIO knows the reality of the existing legacy systems mixed with newer technology and needs a solution that can integrate and operate with a myriad of platforms sitting inside of a carrier. Next slide. For these reasons, it's imperative that a distribution management system offers several solutions in a modular fashion, as Karlyn mentioned. These can meet the diverse needs of these stakeholders, and the four common modules are lifecycle management for licensing and appointment, compensation management for incentive calculations, performance management for management reporting and analytics, and a producer portal for information dissemination and self-service to producers. So let's look at these modules in a little bit more detail. First, next slide. The relationship with the producer begins with the onboarding process. And the ability to do this one-on-one or en masse as entire agencies join is a test of a flexible system. But the relationship with the producer is more than just the appointment process. They bring with them a variety of marketing alliances to be dealt with and a complex contract hierarchy to be set. The company plans to have a long relationship with the producer, which means that the hierarchies and alliances will change over time. And this requires a robust tool to manage not only the initial setup of the producer, but also the full life cycle of that producer's contract with the company. And it's important that the life cycle management tool feed into an agent database that enables a 360-degree view of the producer's time with the carrier. Next slide. The producer's contracts have increased in scope and complexity, and a compensation management system needs to provide the capability for a wide variety of compensation schedules, bonus schemes, incentive contests, and more. A robust compensation module provides for a conversion of historical compensation schemes as well as the flexible modeling of new compensation plans. The calculations are transparent and easily auditable in these systems, and they provide the functionality for payment options matched to a producer and distribution channel's preference. The compensation management system also feeds the same 360-degree view of the producer to enable a full picture of the premiums and commissions generated. Next slide. As the saying goes, what gets measured gets done. A performance management module dynamically interacts with the compensation manager and the lifecycle manager to provide detailed management reporting. This business intelligence can be through ad hoc reports, simple inquiries, and standardized reporting packages. Additionally, a good performance management tool adds another layer of compensation potential. You can incent producers on performance related to short and long-term goals like production tiers, group performance like regions, and policy-level performance like persistency. The performance can also be tracked by agents and managers alike, set through roles and inquiry authorities. Next slide. The final element is a producer portal to provide a timely and accurate view of the information being processed. Producers should not only be able to find status on cases, but should also be able to find detail on commission calculations, changing hierarchies and roles, and management tracking tools for themselves and their teams. The portal and supporting modules are an important touch point with the company, and this will be many producers' view of how easy a company is to do business with, and should not be underestimated in terms of detail, transparency, and self-service functionality. Next slide. As we all know and have heard earlier, the world of insurance sales is a complex business. No longer do we have straight lines of a captive agency to an agency manager to a company. We have a wide variety of alternative distribution and an alphabet soup of MGAs, IMOs, PPGAs, and so on. Add to that the home office and the internal and external wholesalers and relationship managers, and these relationships and lines will continue to get more and more complex in the future. A system will need to be able to handle N levels of hierarchy, both vertically and horizontally, especially at global firms. Next slide, please. But outside of this complexity, the basic fundamental relationships remain. Take something like transfers. Next slide. The Ricky changes managers and her policies go with her. So a system needs to be able to follow that along with Ricky's change. If Chris moves to a management training program but leaves his policies with John for servicing, the system also needs to be able to be flexible enough to move those policies seamlessly. Next slide. And one more slide on, too. The attributes affected by this movement must be done correctly the first time. A seamless interface allowing graphical changes to hierarchies and drag-and-drop capabilities go a long way to ensuring that these movements are made seamlessly. Can you go one more slide? The terminations are equally as important to make the movements quickly, seamlessly, and accurately. Speed and focus on attributes changing at all levels from manager to agent to policy make these basic fundamental relationship movements work even in the midst of complex overlay of modern distribution. So if we can jump down a couple of slides. What exactly is it that keeps the complexity from overwhelming a carrier system? What it is the careful mapping and application of rules within the distribution management system. We can go down to the rules mapping. Take, for example, the contracting options. First, there may be contracting and compensation rules that are tied to all brokers. Within a broker rule set, there may be specific rules that apply to your largest MGA. You can go 2 more slides. There may be a set of producers within that MGA that generate the most business for a carrier, and a carrier may want this subset to have an additional set of compensation options. And finally, you can go 2 more slides down, there usually in all brokers is a big dog on the porch who may be looking for a set of personalized options in recognition for their unique contribution to the firm. A careful mapping and testing of the rules to ensure that they apply appropriately to all levels of the distribution and provide for this end-tier flexibility will be a requirement for these distribution management systems, especially as these big dogs get harder to find and retain. Next slide. So in summary, we are looking not only at new distribution management system capabilities, but we're looking at a transformational way of viewing the process of a producer's life cycle with a carrier. The process enabled by the current systems allows for real-time onboarding and speed to first dollar production. Changes in commission streams and hierarchy movement can be automated through drag-and-drop capabilities to limit manual intervention, the speed of the movement of producers, and ensure the accuracy of the resulting change. Automated commission processing and individualized payment rules provide a variety of processing speeds and payment options, and the 360-degree view of producers will enable carriers to identify profitable producers, match emerging distribution trends, and apply compensation dollars efficiently. Customized reporting will give managers more control over the identifying training opportunities early and allocating resources for maximum premium production. Finally, self-service options give the producer more direct control over the details affecting their take-home pay. Last slide. So we at MajescoMastek have a long history of experience with distribution management around the globe, and we have extensive experience providing solutions to life and P&C carriers, most recently helping carriers analyze the linkage points between these business lines and producers who work in both. So you can see that we have a deep R&D capability, broad IP offering, and an extensive history of delivery success, and our size, scale, and proven IP and offshore advantage provides a unique solution to carrier clients. Thank you, and back to you, Anthony.
Thank you, Erik. And now our attendees will see a feedback form that's opening up on your monitor. To complete the form, please press the Submit Answer button at the bottom of the page. We thank you in advance for filling out this form. Your participation in the survey helps us to improve future webcasts. And now we have a couple of minutes to take some questions. We have quite a few. We'll squeeze in what we can in the limited time we have. I'd like to address a question to you, Erik. Do you have any statistics on how much distribution management technology can help reduce costs?
Yeah, and we've seen as companies pick the different modules and put them in, that there really is an efficiency gain from a potential of 30 to 40% around the reduction in cost of manual processing, as well as you typically see an uptick in production because of the way that the producers are seeing more service, more self-service, and feeling better about the company as a whole and their ease to do business with them.
Karlyn, I have a rather specific question from one of our audience members. Does your research show any effect if a company implements a pre-fill application for producers?
You know, we didn't specifically look at pre-fill, but what we've seen in other types of research, you know, in typical e-commerce, is that pre-fill does have a positive impact. People are definitely looking for simplicity, and the faster that you can complete an application or complete a form, the more likely you are to use it. So we would say, yes, a positive impact would be expected from pre-fill.
Well, we have another question that's kind of related, so maybe you could follow on with this. How important is self-service? Do you see agents actually using it, and do many carriers actually provide it?
Self-service, frankly, is quite important, particularly on the commission side. The survey that we did earlier where I showed you some of the information, what I didn't point out there was the importance of the self-service commission. While the individual producers don't really utilize online commission statements because typically that's not something they would have access to anyway, it was one of the top 4 drivers for the principals at the agencies. So enormously important for the principals at the top-performing agencies in terms of driving business to a carrier. And carriers definitely are providing it. Agents definitely are using it.
Very good. And a question for you, Rich. Did you involve agents in your initiative, and what steps did you take to get their input and buy-in?
We did, and actually it was quite fortunate for us because when we brought them in, obviously we were bound by the agreements themselves, the agency agreements and the marketing agreements as far as what the compensation levels were going to be. But having them involved in the design and actually the discovery phase of bringing in our solution enabled them to understand the complexity associated with the different channel conflict, and having that understanding went a long way as far as their buy-in into the model that we were proposing.
One more question, and I'm going to address this to Karlyn. Erik, if you like, you can follow up. I find this a very interesting question. Since the underwriter-agent relationship has diminished, is the new underwriting model becoming more technology and statistical-based as opposed to the more traditional desk underwriting approach? And I guess that question would go beyond personal lines into some of the more complex risks, Karlyn.
Wow, you know what, I think that's a really great question, and I think, underwriting is definitely changing. And let me talk about commercial insurance on the property casualty side because that's probably the most complex. The use of business rules to assist with the underwriting decision, and I say assist, not replace, it has become a very, very powerful capability in terms of improving profitability. Certainly the small commercial lines can be processed, you know, completely in an automated fashion and is being done so. The next level would be that which is assisted by business rules and looked at by an underwriter. And then, of course, the complex business is still heavily managed by an individual underwriter. But utilizing business rules in terms of scoring the risk characteristics on the account, while it drives profitability, still is not 100% of underwriting. The management and maintenance of the distribution channel along with that is a key underwriting characteristic. I mean, we all know that the distribution channel has an enormous impact on the overall relationship with the client, and so utilizing that data and that information as well is clearly changing the face of underwriting.
And Erik, a quick comment about how this might be changing your approach as a vendor?
Yeah, and we fully agree with that. The technology around underwriting is changing significantly, particularly on the life and annuity side, where there's a lot of different rules-based tools to do the underwriting, and not only from an automated fashion for quicker throughput, but also just providing better information to underwriters to make their decision, more databases that you can access, more requirements that you can pull in to make your underwriting decision more accurate. So there definitely is a higher level of technology capability and a changing process around underwriting overall.
Well, thank you, Erik, and thank you, Rich and Karlyn. That concludes today's event. For those of you who submitted questions that we didn't have time to address during the webcast, one of our experts will send you a personal response via email. Thank you for attending today's webcast, Keeping Agents Focused on Customer Acquisition, brought to you by Insurance and Technology and MajescoMastek. For more information about today's webcast, please visit any of the resource links open before you. Within the next 24 hours, you'll receive a personalized follow-up email with details and a link to today's presentation on demand. Additionally, you can view today's event on demand by visiting www.insurancetech.com/webcasts. This webcast is copyright 2010 by United Business Media, LLC. The presentation materials are owned by or copyright, if that is the case, by Insurance and Technology and or MajescoMastek, who are solely responsible for its content and individual speakers are solely responsible for their content and their opinions. On behalf of our guests, Karlyn Carnahan, Richard Hayburn, and Erik Stockwell, I'm Anthony O'Donnell. Thanks for your time, and have a great day.